In the late 1990s, Iceland was a small, stable Nordic country of fewer than 300,000 people. Its economy was built on fishing, aluminum production, and geothermal energy. It was not considered a financial powerhouse. It was not considered a global risk. Within a decade, that would change. Between the late 1990s and early 2000s, Iceland liberalized and privatized its banking sector. Major institutions including Landsbanki, Kaupthing Bank, and Glitnir moved into private ownership under governments that favored deregulation and integration into global capital markets. This was not unusual at the time. Across Europe, financial markets were opening. Capital flowed more freely than ever before. Risk felt manageable. Growth felt permanent. After privatization, Icelandic banks expanded aggressively abroad. They borrowed heavily from international credit markets and invested across the United Kingdom, Scandinavia, and other parts of Europe. They acquired foreign companies. They opened branches overseas. They moved quickly and confidently. By 2007, the combined assets of Iceland's three largest banks were roughly 9 to 10 times the country's entire GDP. Iceland's annual economic output was around $20 billion. The bank's balance sheets exceeded $150 billion. For a nation of that size, this level of exposure was extraordinary. At home, credit was abundant. Households borrowed more. Property prices rose sharply between 2003 and 2007. The Icelandic krona strengthened. Unemployment remained low. Iceland ranked high on global measures of prosperity and human development. Some Icelandic financiers were described in domestic media as business Vikings, a term used to celebrate their overseas expansion. The prevailing narrative was one of ambition and success, but there were warning signs. As early as 2006, analysts and rating agencies began expressing concern about the scale of the banking sector and its reliance on short-term foreign funding. The banks were financing long-term investments with borrowed money that needed to be constantly refinanced. As long as global credit markets remained open, this model could function. The vulnerability was structural. If international liquidity tightened, Iceland's government did not have the financial capacity to support banks of that size. This imbalance would later be confirmed in detail by the 2010 report of the Special Investigation Commission appointed by the Icelandic Parliament. In September 2008, the global financial crisis intensified following the collapse of Lehman Brothers in the United States. Credit markets froze. Banks around the world struggled to access funding. For Iceland's financial institutions, which depended heavily on short-term wholesale borrowing, the impact was immediate. On September 29, 2008, the Icelandic government announced partial nationalization of Glitnir. Within days, events accelerated. On October 6th, emergency legislation granted authorities sweeping powers to intervene in financial institutions. On October 7th, Landsbanki was taken over by regulators. On October 9th, Kaupthing collapsed. In the span of little more than a week, Iceland's three major banks had failed. The Icelandic krona depreciated sharply. The stock exchange suspended trading. Capital controls were imposed to prevent further outflows of currency. For a country of just over 300,000 people at the time, the scale of the collapse was enormous relative to its economy. The consequences extended beyond Iceland's borders. Landsbanki had operated online savings accounts in the United Kingdom and the Netherlands under the name Icesave, offering interest rates that attracted hundreds of thousands of depositors. When Landsbanki failed, those accounts were frozen. The United Kingdom invoked anti-terrorism legislation to freeze Icelandic assets in Britain, a decision that strained diplomatic relations. The UK and Dutch governments compensated their citizens and sought repayment from Iceland. The issue became politically explosive inside Iceland. Two national referendums were held in 2010 and 2011, and voters rejected proposed repayment agreements both times. In 2013, the EFT court ruled that Iceland had not violated its deposit guarantee obligations under the specific legal circumstances of the crisis. Domestically, public anger intensified. In late 2008 and early 2009, protests erupted outside the Alþingi, Iceland's parliament. Demonstrators gathered in central Reykjavik, banging pots and pans. The protests became known as the Kitchenware Revolution. In January 2009, the government resigned. Early elections followed. Iceland was one of the few countries during the global financial crisis where political leadership fell directly as a result of financial sector collapse. Investigations began quickly. In December 2008, Iceland established a special investigation commission to examine the causes of the crisis. Its report, published in April 2010, concluded that bank executives had engaged in risky lending practices and that oversight mechanisms had been insufficient. It identified conflicts of interest and systemic weaknesses. Unlike many larger economies, Iceland pursued criminal cases against financial executives. Several high-profile bankers were prosecuted and convicted in cases involving market manipulation, breach of fiduciary duties, and other financial crimes. Some received prison sentences confirmed by Iceland's Supreme Court. In November 2008, Iceland secured a $2.1 billion loan from the International Monetary Fund. Economy contracted sharply in 2009. Unemployment rose. Capital controls remained in place for years to stabilize the currency. Over time, recovery began. Tourism expanded rapidly. The krona stabilized. Economic growth resumed. Capital controls were gradually lifted starting in 2015 and fully removed by 2017. Iceland's collapse became a global case study. It demonstrated the risks of financial sectors, growing far larger than the economies that support them. It illustrated the vulnerability of funding long-term investments with short-term borrowing. It highlighted the limits of regulatory oversight in rapidly expanding markets. It also showed a different path from some larger economies. Iceland allowed its major banks to fail. It prosecuted executives. It imposed capital controls. It renegotiated its international obligations through legal and political processes. In 2007, Iceland appeared prosperous and globally integrated. Its banking system symbolized ambition. Within weeks in October 2008, that system collapsed. The events were not the result of a single decision or a single individual. They were the product of deregulation, global liquidity, political confidence, rapid expansion, and structural vulnerability. For a brief period, a small island nation became one of the most financially leveraged economies in the world. When global credit stopped flowing, the model could not hold. The tide turned, and the island had to rebuild.